And the IMF Fiscal Monitor Report for 2024 shows that highlighted some projections that debt to GDP ratio, currently at 50.7%, is expected to drop to about 49.6% by 2025. It noted that the country's public debt includes overdrafts from the Central Bank of Nigeria and liabilities from Asset Management Corporation of Nigeria. Well, let's discuss this and other matters now with Mr. Sam Chidoka, as the MD CEO and Korea Advisory Services, joining me via Zoom. Great to have you on the show.
Yeah, good morning, or good afternoon, actually. Good to be here. Thanks.
Always great to have you. So, what would you say are the implications for Nigeria's decreasing debt to GDP ratio? You know, what kind of impact should we expect on its economic stability and especially credit worthiness?
Well, so for Nigeria, it's good news. The World Bank is projecting that our debt to GDP would come down from 50.7% to about 49.6%. What that should generally do is should improve our perception, because there is something about perception, or there is a theory that is called the signaling theory. So this is going to help signal to investors and the world over that Nigeria is getting into a better place. So typically what you would expect is that for that to happen is either our debt burden reduces or our revenue goes up. Our GDP begins to go up as well. So if GDP goes up or debt burden reduces, then the debt to gross domestic product ratio would definitely reduce. If any of that happens, it's a good signal for Nigeria. You would expect that it shows we have improved fiscal health, we have capacity to service our debt, and investors will look at us gladly with that happening.
And, to make this happen, and definitely it's not that simple, at this time where we're seeing a government that's trying to raise, revenue at this time. When it comes to, raising revenue, what would you say are the low-hanging fruits, this government can actually look at right now and say, what, we can, tap into this to boost our revenue? That's in the short term.
Okay, so in terms of revenue, yeah, you're right. There are some low-hanging fruits. And unfortunately for the government at the center and the managers of our economy, this is not the best time to talk about increase in taxation, because already a lot of people are going through a lot based on the devaluation of the currency and then increase in inflation that we have seen over time, which has affected people's purchasing power capacity and driven so many households with the inability to just sustain themselves. So this is not the best time to increase tax, right? But what you can do is to have some level of fiscal responsibility, first of all. Even within the revenue that you presently have, there should be responsibility in terms of, let's spend on the critical aspect of the economy. Let's begin to reduce recurrent expenditure and increase capital expenditure and reduce some of this, what I call lifestyle financing that we find for people in government. Aside from that, we need to explore areas of our comparative advantage. One of it is agriculture. We're not exporting it. We're not exporting enough. We're not even using enough to reduce food inflation and talk more about exporting. So we've got to explore looking for revenue other than oil and gas revenue. We can do that through agriculture. We can do that through services. We can do that through diaspora funding. I think that Nigeria must get to the place where we begin to have policies that link Nigeria with exporting human capacity to get revenue into the country as a direct policy of government. It wouldn't hurt us.
Right, and on talking about hurt at this point, we know the IMF, they have a couple of recommendations, so as the World Bank, for, the Nigerian government to actually stabilize, the currency, helping, boosting revenue at this time and reducing debt. But, looking at all of these recommendations, do you think more pain, should be expected, to the citizens? Because at the end of the day, we've seen how most of the reforms have impacted, ordinary Nigerians.
So you see, whenever it comes to the IMF or the World Bank or Bretton Woods institutions, my view is always you should listen, but you don't have to swallow everything hook, line, and sinker. We do not have to do everything that the IMF tells us to do. we have to take policies and localize them. We have to take policies and put them in tandem with what is happening in the country. If you have a country where you have over 100 million people living in poverty, then sometimes some of the imported policies might not be the best. Because typically what you would hear people talk about tax to GDP, how it is low in Nigeria. How can you grow that pot of increasing our tax to GDP? Yes, but the question is, do we have enough people that have the capacity to even pay the tax? And you have to remember that we run a country and an economy that is interdependent in terms of how people relate. The reason why so many people are surviving in this country today is because those who are making money are supporting a lot of people who are not. So if you tax the people who are making money more, you're also going to affect the people that they support. There's a domino effect. So again, when it comes to recommendations by the IMF, I'll say, listen, but you don't have to do it all. Let's localize it. Let's look at what will work within the parameters of what we can do. Let's look at how we can be productive. Let's look at industries that require human capital and we can create more employment, reduce inflation by coordination between the fiscal and monetary policies that are in place, and try to get the economy working. And when we have more people that have capacity, then you can talk about some of the recommendations of the IMF.
And we've also seen recommendations to the central bank, for keeping rates high. At this point, we've seen how the CBN has tried to tackle, rising inflation by, increasing rates at most of the meetings. And there's also expectations that rates can even go higher, at this point. So talk to me about how this is impacting, businesses. Most of the businesses listed, on the stock market at this point. I'm seeing that it's a high interest environment and it's expected to stay even higher, going forward.
Look, Ladi, businesses are bleeding, and that's just the truth. With this high interest rate regime that we have, capital formation becomes very difficult, especially when you look at the debt side of capital. Typically, we would always say in our markets that equity is more expensive than debt. Why? Because the equity return expectation is usually higher than debt. But today, the debt market is probably higher in pricing than the equity market today in terms of equity expectation. When you have a situation where a company goes to a bank to take a loan and you have to pay over 30%, 35% in a working capital loan, what sort of business is that company doing that will return 35% and return something else above it, a premium above it, that will take care of their other expenses, pay salaries, overheads, and still be able to make a buck? So in this high interest rate regime, we understand that the central bank is trying to fight inflation, and that's commendable because inflation at the end of the day affects all of us. But there has to be an equilibrium point. There has to be a breaking point. Today, corporates are going to the commercial paper market and issuing papers for 6 months, for 9 months at 28%, 30%, 32%. That's expensive. And that's going to affect their capacity and their ability to keep on to their going concern status as it is. So again, whilst I commend the CBN for trying to fight inflation, I think that those on the fiscal side need to pull up their stocks as well and help to make this work. But continuous increase in rates might begin to bite us in the wrong place.
So you're saying at the next meetings we should have some kind of maybe a hold at this point?
I'm hopeful it will be a hold because you see, in the recent past, inflation, even when inflation has gone up, it's been going up in a reducing stance, right? So we've seen inflation continuously going up. We saw it taper down just a bit.
All right, we see it's actually raining right here in Lagos, so we're seeing the impact already on Mr. Chidoka's Zoom there. So, Mr. Chidoka, I don't know if you can hear me now. I lost you for a moment there, but definitely the issue about inflation and trying to lower inflation, but at the expense of growth is definitely a very delicate balancing act there. And we're seeing the central bank, have to pull through at this time. At the last meeting consensus, when we look at minutes from that meeting, it was all about, raising rates from all of the members and expectations. Investors are always trying to find out what's the forward guidance, what's going to happen, at the next meeting. So all indications are we might actually see more rate hikes at this point. But the question is, how much wiggle room does the CBN MPC, have, to raise rates more at this time? Because at the end of the day, this is sacrificing growth to tame inflation. And, some would say it's not, inflation is not lowering as fast as we would like. And also when it comes to currency issues, we've seen the CBN intervene, in the official window and also in the parallel market, by selling dollars. That's to the BDCs. But we'll definitely see it's a brand new week. We'll see how the Naira performs, and we're also looking out for inflation numbers and the next meeting. That's for November.